Markets are now 2% away from record highs again. Interest rates seemingly are back on the rise. The yield curve is no longer inverted. So is that an all clear for markets right now? The bull run resumes?
I don't necessarily think it's an all clear, but short term, we are seeing assets attracting the S&P 500, breaking out of that range. But what's interesting, you bring up the Treasury curve, and you saw the 10-year, the two-day biggest gain, 14 basis points. It's moved up in yield, lower in prices. We haven't seen a move like that since June of 2011. Today, we saw 1.75 nearly printed. So I think that is kind of a sigh of relief as we continue to see markets inching to that all-time high.
So, Mark, I mean, interest rates, have they bottomed out? And if so, has the move in financials, other defensive parts of the market, really kind of signaled that this is maybe a rally that could have legs past towards new record highs?
I do think interest rates are headed up. I mean, I do believe that the Fed's going to cut by 25 basis points this month, probably 2 more times before the end of the year, 4 more times over the next 12 months. As they cut on the short end of the curve, the long end of the curve, I would expect to continue to go up. So the most interesting thing that I've seen over the last few days is this heavy rotation, right? So this year's big winners have been the big losers over the last few days. That's a lot of these defensive plays, whether it's consumer staples, which were very rich, utilities, real estate. And this year's worst performers have been up big. I mean, you look at like a Macy's and a Nordstrom. Those 2 stocks are up around 20% over the last week. And I don't think a lot of people are dying to get into Macy's stock right now. So you're seeing the low PE stocks outperforming, high PE stocks underperforming. And what I think that means is I think it means that the market is reassessing whether a recession is actually right around the corner. And the market seems to believe that it's not.
All right. So Jeff, here's my question. What prompted it? I mean, usually there's something. I mean, there doesn't have to be one proximate cause for it, but there has to be a reason why there is a quote unquote rotation even starting or one that has legs. So what was it? Interest rates? Was it something else in the marketplace that really prompted this whole get me out of these certain stocks and get me into others?
I think it's more repositioning. Mark hit the nail on the head. When you talk about repositioning going into the ECB meeting on Thursday, next week we obviously have the Federal Reserve. So yesterday was a great illustration when we saw the top 100 names in the S&P 500. They were down over 1%. What does that mean, Dom? That means that they were booking profits. The bottom 100 names in the S&P 500 up nearly 2.5%. So that reposition, that sector tilting, you're seeing a lot of people kind of button down and book profits and also get ready for the end of Q3. We are getting ready for Q4. And if we do see some trade tariff resolution, it's going to be a heck of a Q4 and maybe the Santa Claus rally of all Santa Claus rallies.
So this is a different setup-ish than it was last year.
Agreed.
We were kind of steadily grinding towards these record highs, only to see a sharp sell-off in the later part of the fall into the winter. Is that kind of setup maybe something that happens again this year?
I don't see the volatility like we saw in Q4 of 2018. However, be mindful of the VIX. People are willing to pay option premiums right now with the VIX above 16. I do think we will see a little back and fill, but right now it's pretty optimistic as long as the trade tariff conversation and the sentiment stays optimistic.
All right, so then, Mark, what goes on your shopping list, given the idea that we are seeing rates kind of move the way that you're talking about, and you mentioned this rotation, the companies there that go on your shopping list right now include what?
Yeah, so the strongest part of the economy right now remains the consumer, and that's over 70% of our GDP. So consumer confidence is still high. Wages are growing, unemployment's low. I mean, even small business optimism is still high. So the consumer is strong, but their buying preferences have changed. The consumer's now more price conscious. So you look at companies like TJ Maxx and Dollar General. So TJ Maxx is really the best off-price retailer out there. And when all that apparel doesn't get sold at Macy's and Kohl's, it goes to TJ Maxx, and the consumer loves that treasure hunt experience. When you look at Dollar General, I mean, over 75% of their business is consumables. That's food, household cleaning products, stuff like that. So regardless of where the economy heads, that company's going to work.